The broadcast is now starting. All attendees are in listen-only mode.
So when we are looking at the structure of the webinar, we are going to divide this webinar into three broad parts. In the first part, I will discuss what is retail banking, then retail lending and the objectives of lending. In the second part, we will understand who are the players in the US consumer lending, who are the regulators in US banking industry, the basic lending process from US perspective, and the most important part will be covering the regulation in brief, the regulation which is applicable to consumer lending in USA. So this is our part 2, and the third part will include an overview of major US retail lending products. So I will be talking about mortgages, I'll be speaking about student loans, and I'll be speaking about the auto loans when we carry out the discussion. So with this agenda, today, let us begin our discussion. Now, so far as the question answers are concerned, whenever you have a question, I request you to type that question in the question pane. I will not be taking any questions during the delivery. I will have a separate question and answer at a later point of time. So when we are looking at when we complete my delivery, then I will open your sound systems so that you can speak with me, and then we can exchange our views on the questions. So this is how we'll have the question and answer session at the end, but at the same time you can type your question at any point of time on the question pane which is there in front of you. So let's begin our discussion on the lending systems. Now, as all of us are aware, the primary function of any bank is to accept the deposits and to use that money to dispense loans or to make investments. So we take loans and we take deposits, and then we use that money for lending purposes. But every time we sanction a loan, we are going to create an asset in the books of the bank, and our objective of lending is to earn a return, and that return will usually come by way of interest on our loans. The other reason why a bank is required to lend is because lending itself will stimulate the business activity in the economy. Now, there will be two kinds of people in the economy. One, those who have money, and those who need that money. So a bank plays a role of a platform, a financial intermediary, where both the lenders and the borrowers come together and they're able to exchange money. And through this, we enable the businesses to gain more money, and through that more businesses can start. That is how the banking system works. Now, having understood about the activities of the banking system, let's understand the three major lines of business before we start discussing retail banking and then the consumer lending in United States. Now, from the perspective of a client, the activities of a bank can be broadly divided into three kinds of clients. The first type is corporate banking, the second type is private banking, and the third type is retail banking. Now, corporate banking would refer to providing banking and financial services to large corporate clients. Your examples of a large corporate client could be somebody like Ford Motors or maybe British Airways, and they need large amount of money and they need many other banking facilities. On the other hand, when we speak about the private banking refers to providing services to ultra high net worth and high net worth individuals. Somebody like Bill Gates or somebody like Mukesh Ambani from India, or even a couple of you who are rich enough, will be getting the private banking services from the bank. And the last category is retail banking. Retail banking is also known as consumer banking. So when I'm using the word retail banking or consumer banking in this session, I'm going to use them as if they are synonyms. So I may use the word consumer banking or retail banking. The typical American word for that would be consumer banking. So in retail banking, it is about providing services to masses, whereas private banking is a class banking, retail banking is the mass banking. So these are the three basic lines of businesses. Now, having understood the activities of the bank of accepting deposits and lending money, and then dividing the bank into three basic types, that is corporate banking, private banking and retail banking, let's move on to understand the objectives in lending. Now, when we lend money, we are obviously acquiring risk. And one may say that let's completely eliminate the risk in lending, and so that we don't lose anything out of that. But we must understand the fact that if we eliminate the risk, then there is not going to be any reward. And therefore, rather than elimination of the risk, we should start thinking about optimization of the risk when we are lending money to somebody. And when we lend money, there are various risks involved in lending, and the major risk which you face while we lend is the credit risk. It's actually the biggest and the most obvious risk, and lending is resulting into losses many times because there is a possibility that your borrower may not repay the loan taken from you. So he will not pay you the principal amount, he may not pay you the interest on that amount. So one of the risks which you have in lending is the credit risk, that the possibility that our borrower does not make the repayment. But apart from credit risk, we also face many other risks while we lend money. And before we move further, we need to understand those other risks also which are involved in lending in addition to the credit risk. For example, we always lend money and the return which we expect is the interest on that loan. Now it is very necessary for us to ensure that the percentage or the rate of interest at which we charge the borrower is always more than the rate at which we are going to pay the depositor. In simple terms, my net interest margin, which is the amount of interest earned less the amount of interest paid, is always on a higher side. So I need to earn more. And it is possible that if you are accepting a deposit at a rate which can become higher than the lending rate, then my bank is going to lose the money. So I have to ensure that at every point of time when I lend money to somebody, the interest charged to the borrower always remains higher as compared with the interest payable to the depositor. Now one may say, how could this happen? It is possible that the loan interest is a variable rate of interest, the fluctuating rate of interest. And on the other hand, the deposit rate is a fixed rate of interest. So let's take an example. You have accepted a deposit at a fixed rate of 6%, and your lending rate today is a floating, a variable rate of 8%. So today your net interest margin is 2%, but it is possible that the floating rate starts dropping, and in that situation we may end up losing money and your net interest margin may become thinner and thinner. So another risk which you face in addition to the credit risk in lending is the interest rate risk, that the interest which you earn from the loans may sometimes become less than the interest which you pay to the depositors. We need to think of another problem as well. It's not necessary that whenever you lend money, you always accept a deposit in the same currency. Let us take an example to understand this. Now I am accepting a deposit in a currency euro, but it's not necessary that my loan will always be given in the currency euro. I may give the loan in any other currency like the US dollar or maybe something like the British sterling pound. So in the case the deposit is accepted in a different currency as compared with the loan given in a different currency as compared with that deposit currency, then I may face an exchange rate risk. Deposit accepted in euros, the loan given in US dollars. Any variation in the exchange rate is going to impact me through this lending. So when I lend money, I need to take care of this aspect also, that the exchange rate variation does not impact my bank. Third, and the major risk which you face because of lending is the liquidity risk. You always expect your borrower to repay the loan in the given time as per the amortization schedule which is there in the documentation. Now if the borrower fails to make the repayment of your loan in time, we still have the commitment of making the repayment of this loan to the depositor. So if you fail to pay the depositor, your bank will have a reputational issue. So we need to ensure that even if the borrower does not make the repayment to us, we should always maintain adequate liquidity at our bank so that we are able to repay our depositor anytime the money is due to the depositor. So in this way, just to summarize, in addition to credit risk, we need to manage the interest rate risk, we need to manage the exchange rate risk, and we need to manage the liquidity risk. And for taking all these risks, a bank needs to get compensated. So what would be the benefit the bank gets? The reward which the bank gets is the interest earned. So when we charge interest on the loans, we need to ensure that the banks gets adequately compensated not only for acquiring credit risk but also for acquiring other risks like the liquidity risk, like the interest rate risk, and like the exchange rate risk. So your pricing of the loan, that is the interest which you charge to the borrower, should consider all the aspects of risk which the bank is going to take and should not focus only on the credit risk. That's the point I wanted to make. So now the next point is, when we get this reward, the reward could be interest earned by the bank or sometimes premium earned when we sell our loans. Now, in many countries, it is not a practice to sell the loan book. But if you look at the United States, I may have a primary market for loans and I may have a secondary market for the loans. In the primary market, as a lender, I will originate the loan, and once the loan is given to somebody else, I will sell that loan off to somebody else, some other lender or some other party who is interested. And then while I sell this loan off to somebody else, I will earn a premium on that loan. So in United States, it is possible for me to get a reward through interest charged to the borrower, and again premium earned on the interest which are sold by me, on the loans which are sold by me in the secondary market. So we will have the interest earned and the premium earned as my rewards. Having understood the risk and reward relationship, let's understand the impact which the regulation will have on your lending. So now what we are speaking about is the volume making and quality making about a loan. So I need to optimize the volumes, I need to optimize the quality. Now when I want to lend, my regulation is going to impact the volume of the loan. Let's take an example to understand what I mean by volume of the loan getting impacted by the regulation. We are going to speak about two basic regulations which impact our lending. The first regulation I'm going to speak about is what is called as Regulation D in the United States. It speaks about maintenance of reserve ratios. In countries like India or in many other countries, we use the word the cash reserve ratio, or we use the word statutory liquidity ratio. In simple terms, under Regulation D in United States, I need to maintain a certain percentage of my transaction deposits by way of cash in my vaults or cash balance with the the central bank, which is the Federal Reserve Bank there. So assuming my deposit is $100 and the Federal Reserve defines the reserve ratio of 4%, I'll need to keep out $4 out of this amount. That means the amount available to me for lending will become only $96. If the Fed changes the rate from 4% to 6%, out of every $100 of transaction account deposit which I have, I'll need to keep aside $6 and I'll be able to lend only $94. To summarize on this point, the point is that the reserve ratios decided by the central bank are going to impact the amount which will be available to you for lending, and this is one factor which is going to decide your capacity or volume of lending, the reserve ratios of the Regulation D in United States. The other regulation, which is a global regulation, all of us have, I'm sure, have heard about the Basel Accords. So we'll have Basel Accord 1, Basel Accord 2 and Basel Accord 3. Basel Accord typically defines the capital adequacy requirement. So what we are now going to discuss is the capital adequacy requirement. When I speak about capital adequacy requirement, we need to understand in lending the concept of capital adequacy ratio. Let me explain this point as how does this impact your volume of lending. Now let's imagine that you have given a loan of $100. Every loan has to have a risk weight assigned to it. The risk weight could be designed by the bank itself if you are following an advanced mechanism. It is called an internal rating based mechanism. Most of the Americans banks do follow the internal rating based mechanism. So I could have an internal risk weight assigned to it. Alternatively, the Basel Accord itself defines the risk weights. And let's assume, for the sake of understanding here, that in respect of this loan, the risk weight assigned by the regulator is 50%. Then $100 of loan amount multiplied by the risk weight of 50%, my risk weighted asset is $50. The Basel Accord defines a capital requirement, a capital ratio of 8%. So when I have the capital requirement of 8%, well, if I put 8% here, my capital requirement would become $4. So $50 of risk-weighted asset multiplied by the capital ratio of 8%, my capital requirement becomes $4. Now let's work the other way around and understand how this impacts my volume of lending. Now assume tomorrow that the Federal Reserve changes the risk weight of the same asset from 50% to 75%. My capital requirement would now jump from $4 to $6. And obviously, at any given point of time, the bank is not in a capacity, is not in a position to continuously increase its capital. So the only way it can now handle this compliance requirement of capital adequacy ratio is reduce the exposure from $100 to $60. Since I am not in a position to raise my capital from $4 to $6, I may be required to reduce the loans which I am giving from $100 to $60 because my capital cannot instantaneously change from $4 to $6. So if I keep on having capital of $4, then the lending has to go down to the extent of $60. In this way, two important ratios, which is the reserve requirement, I use the word the regulation D in United States, and the capital adequacy ratio, both impact your lending volume. In addition to the volume which you are going to generate in lending, we need to also understand the quality of the borrowers. It's not necessary that we will lend money only to those borrowers who are of very good quality. Because if you lend to a borrower who is rated AAA or who has got a very good score, credit score, then the return which you're going to get from such a borrower is going to be less, because less risk will result into lesser reward. So to summarize on these goals in lending, the goal is to optimize the risk. While we optimize the risk, we need to ensure that we maintain adequate volumes, and the volumes could get impacted because of reserve requirements, something like regulation D in USA, and also the capital adequacy ratios. We also need to ensure that we have a proper mix or proper quality of borrowers in our lending mix. This is how we have the key goals decided while we lend. Now when we lend the money, let's look at who are the entities involved in US lending. When I speak about the entities involved in US lending, I'm going to speak about who are the lenders. I'm going to speak about who are the regulators, and then also the other entities other than the lenders. So when we speak about entities in the US market, let's first understand the two types of lenders. One, who are traditional lenders, and two, who are the modern types of lenders. So when I speak about traditional lenders, in traditional lenders, I will have the depository institutions. The depository institutions will be classified further into commercial banks, credit unions, saving banks, and savings associations. Now, depository institutions are those institutions who accept a deposit. Commercial bank, an example of a commercial bank in United States could be somebody like Citibank or somebody like the Wells Fargo. So we have these kind of commercial banks. We have various credit unions also in the United States. In addition to these credit unions, we'll have the saving banks and savings associations also lending the money. These are our traditional lenders under the category of depository institutions in the United States. In addition to that, in United States, you also have life insurance companies who lend money mainly in the long-term market, which is usually for consumers, it is the mortgage market. So we'll have, these are the traditional lenders, depository institutions and the life insurance companies. In addition to these traditional lenders, we also have the new marketplace lenders. In this new marketplace lenders, I've got three categories: direct lenders, then we have the platform lenders, and then we have the hybrid lenders. Now these marketplace lending firms have evolved to offer a wide variety of loan products and services to consumers, and they have recently begun to offer mortgages, life insurance, and auto loans. In this, there are typically three basic models. Direct lenders is model 1, platform lenders is model 2, and the third one is the hybrid, a combination of a direct and a platform lender. Now when we speak about direct lenders, who are also known as balance sheet lenders, they acquire money, they obtain capital from outside sources and then use this money to give loans. That means the accepted money is on their books and the loans given are also on their books. And then the examples of such parties could be somebody like the Cabbage or somebody like the Sophie, which you see on the screen. So these are our examples of direct lenders. Sometimes the platform lenders participate with the banks who originate the loan. So what is a platform lender? Where we'll have the borrowers and the lenders coming together. So there is one platform, a technology platform created, something like what we have on the commodity side, somebody like Amazon. You want to buy something, you go to Amazon. Somebody wants to sell something, also goes to Amazon. Amazon is a platform where both the buyer and the seller come together. In the similar way, we'll have somebody like Lending Club or a Prosper or an Upstart, which are the platforms which provide opportunities for both the borrowers and the lenders to come together, and through this platform they will lend the money. Now in this case, the platform does not take any credit exposure. The platform plays a role of bringing both the types together, the borrower and the lender, and the platform will charge a certain fees for providing this service. The third type is the hybrid lender. The hybrid lender will be a combination of a direct lender. Sometimes they lend out of their own money, sometimes they bring the borrower and the lender together. So these are the players in the US market. We have spoken only about the lenders. Now our discussion is going to be focused only on the traditional lenders, and that too only in respect of depository institutions. Now in addition to these lenders, we'll have various other players like the brokers. We have an example on the screen of the mortgage broker. Now when the loans have to be sold in the market, a borrower, an applicant, instead of directly approaching a bank or the depository institution, may approach a broker and through the broker try to identify a suitable lender who will be willing to lend the money to this applicant. So brokers play an important role in the American lending market to bring the applicants and the lenders together. This is part number one. The other type which you see on the screen are the servicing agencies. Now typically in most of the countries, when a bank lends money, it is the bank who would keep on then subsequently collecting the money from the borrower. So if their installment has to be collected, the bank would collect the installment from the borrower. But in United States, there is a practice to appoint a third party, which is called as the loan servicing agency. And this loan servicing agency will approach all the borrowers and on behalf of the lender, collect the money from the borrowers and send that collection to the lending institution. So in this way, the servicing agencies will earn a return, some kind of income from the lenders for providing the servicing facility to the lenders. So we have seen the lenders in the US retail industry. Let's now move to the regulators in the US lending industry. Now before we start speaking about the regulators, let me speak briefly about the lending regulation in United States. Now the lending regulation in United States can be broadly classified into prudential regulation and the regulation which is in respect of protection of the consumers. Now when we speak about prudential regulation, it basically focuses on the risk created by the banks when they lend the money, and the risk gets created in the economy. So when somebody like the Federal Reserve or somebody like the Office of the Controller of Currency is regulating the banks, they're regulating the banks or the depository institutions from this angle, that are these institutions going to cause any risk in the economy of United States. So prudential regulation will focus on the risk which emanates from the lenders, whereas the other kind of regulation focuses on the protection of rights of the consumers. So to summarize, I am broadly dividing the regulators and the regulation in United States into prudential, that is regulation focused on risk, and two, regulation which focuses on the protection of consumers' interests. Now the regulators we are currently looking at on the screen are prudential regulators. We have the Federal Reserve, then we have the OCC, the Office of the Controller of Currency. The third regulator which you see on the screen is the Federal Deposit Insurance Corporation, and the fourth regulator which you see on the screen is the National Credit Union Administration. Let me explain to you what roles do they play in the US banking industry. The Fed is the primary prudential regulator for a variety of lending institutions, including bank holding companies, certain US branches of foreign banks, and state chartered banks who are the members of the Federal Reserve System. In simple words, the Fed will regulate global American banks, somebody like Citibank, somebody like maybe Bank of America, which operates within United States and also outside United States. In addition to this, the Fed also regulates the banks which are born outside United States, somebody like the like let's say Development Bank of Singapore, DBS, which is originated in Singapore, may have operations in United States. So the DBS bank's operations in USA, or maybe HSBC is born in UK and has operations in USA, HSBC's operations in USA would be governed by the Fed. To summarize then on Fed governs the global American banks, including their holding companies, and also US branches of foreign banks like HSBC or Mitsui or the Development Bank of Singapore. The second regulator is the Office of the Controller of Currency. The OCC is the primary prudential regulator for federally chartered banks and thrifts. So those banks which are national banks which operate only within United States, and those banks, those entities called thrifts, are regulated by the OCC. The third kind of regulator is the FDIC, the Federal Deposit Insurance Corporations. Don't go purely by the name. In addition to providing deposit insurance for the depository institutions, the FDIC is the primary federal prudential regulator of state chartered banks who are not the members of the Federal Reserve System. And the last regulator is the National Credit Union Administration. It is an independent federal agency created by the United States Congress to regulate, charter, and supervise the Federal Credit Union. So these are the four ones. All four of them will look at the risk created by the institutions in the American financial systems. They are not focusing on the protection of interest of the consumer. In addition to this four, we also have the Federal Housing Finance Agency. Now, when you speak about the Federal Housing Finance Agency, it was created in 2008 after the subprime crisis under the Housing and Economic Recovery Act. The objective is to consolidate and strengthen the regulation of certain government-sponsored enterprises. Now, I have not explained what are these government-sponsored enterprises. I'm going to speak about them when we speak about mortgages in USA. But we have three major government-sponsored enterprises in USA: the Fannie Mae, the Freddie Mac, and the Federal Home Loan Banks. There are 11 Federal Home Loan Banks which are regulated by the Federal Housing Finance Agency. Now, if you look at the regulation type, you would have realized that Fed or the OCC cover all banking activities of a depository institutions. But the Federal Housing Finance Agency acts only in the area of housing finance. That means we have an independent regulator in USA so far as housing finance agency, housing activity of Fannie Mae, Freddie Mac, and the Federal Home Loan Banks are concerned. And the last one is the Consumer Financial Protection Board, which is an important regulator now in the USA. But the focus of Consumer Financial Protection Board is protection of the consumer. This Consumer Financial Protection Board was also created under the Dodd-Frank Act. The objective of the Consumer Financial Protection Board is to protect the interest of the consumers. It does not focus on the bank safety. It does not focus on the soundness of the banks. It focuses on this aspect, whether the banks are likely to cause any injury to the interest of the customers. So it will protect the consumers from unfair, deceptive, and abusive financial practices. That is the objective of Consumer Financial Protection Board. So now to summarize on this point, we need to understand that when you lend money in United States, on one hand, the Fed or the OCC, your prudential regulators are going to regulate you, and on the other hand, the Consumer Financial Protection Board is also going to regulate you. So your lending practices and the process of lending has to comply with two basic kinds of regulators requirements. One is the prudential regulators requirement, and two, your requirement of the Consumer Financial Protection Board so far as the protection of interest of the consumers is concerned. Let's now move to the next part and understand the overall lending process. Now, this overall lending process is typical across the globe. But then USA has divided this into three various different parts. I'm going to explain those different parts to you at this point. So let's understand those different parts. So when I lend money, initially to lend money, I'll have to advertise my products. So I'll have an advertisement of the products. Then you will say, what is there? Every bank in all the countries do advertisement. But then in USA, your advertisements are also regulated by regulation so far as lending is concerned. So in the first part, I'll have the advertisements. Then I'll have the application for the loan. Then when we have the application, we will have to divide these two components and call this for our discussion as loan sourcing. So I'll have the loan sourcing as the first part, in which I will advertise and seek applications from the parties. The second part is where I will have the process of assessing the application, then carrying out the process of underwriting. That means deciding whether to lend money or not to lend the money. Once I decide to underwrite, decide to lend the money, I will carry out the documentation and then I will disburse. This is the second part of our lending process in the United States. I'm going to call this as loan origination. And the third part, after you have disbursed the loan, it could be an open-ended or a closed-ended loan, you need to get your money back from your borrower. So I'll have the collection process. I will have recovery in case the consumer, the borrower is not paying on his own, recovery process, and sometimes I may foreclose the loan. So I have the third step or the third category called loan servicing. So now I have divided the entire lending process in United States into three parts: loan sourcing, loan origination, and loan servicing. And then we need to realize one more point. We have discussed it earlier, that loan sourcing may be done by somebody else. I could have a broker sourcing the loan. A loan origination may be done by somebody like the lender. And after the loan origination is done, the lender may transfer the loan to somebody else for servicing purposes, which means it is not necessary in United States that one single agency will always do the sourcing and origination and also the servicing. We may have three different agencies carrying out the three different activities: sourcing, origination, and servicing. So as I said earlier, there could be a servicer then between the borrower and the lender. The borrower will receive the loan from the lender, and then the servicer will come in picture. Servicer will collect the monthly installments, principal as well as interest, and then give that money to the lenders, and in return the lenders will pay the servicing fee to the servicing agency. So you'll have multiple agencies in this. And then as I'm saying this, you have realized that there are many agencies which play a role in the lending scenario in USA. There will be a different regulation applicable to each of those categories for carrying out their respective activities, like sourcing, like origination, and like the servicing. Let us now move to the regulation. Now we have divided, let's remember that we have divided the activities into three parts: the sourcing, the origination, and the servicing. Now I am beginning the discussion on US retail lending regulation. The US regulation applicable to lending can be broadly divided into two parts. One applicable to all loan products, irrespective of whether it's a mortgage loan or whether it's a auto loan or whether it's a credit card. Irrespective of the loan, the regulation will apply to all categories of loan. Another way to classify the regulation is on the basis of the kind of loan which you have. Is it an open-ended loan? Is it a closed-ended loan? What is open-ended? What is closed-ended? I'm going to take that on the next slide. Third way to classify the US lending regulation is on the basis of applicability to the loan processing. We looked at three processes. The first process was sourcing, origination, and then servicing. Now some of the regulations will be applicable only to sourcing. Some of the regulation may be applicable only to origination, but there could be some regulation which is applicable to all the three processes. To summarize then, I'll have regulation which applies to all the three components: sourcing, origination, and servicing, and some regulation may apply only to sourcing or only to origination or only to the servicing part. Let's now understand the concept of open-ended loans and the closed-ended loans. Now why are we discussing this? Because when you look at the American banking regulation, the US banking regulation, The regulation divides itself: regulation which is applicable to open-ended loans, regulation which is applicable to closed-ended loans. It also divides this into loans which are given after taking a collateral of a house property, loans which are given by taking a collateral of something else, and loans which are given by not taking any collateral. To put it in simple words, I may have secured loans secured by house property, loans secured by any other property. And the second category is no security taken at all. So in this way, the regulation classifies itself. So that's the reason why I'm explaining these categories to you, that we have open-ended and closed-ended credit. Now in open-ended credit, I could have two types. Open 30 days account. I must pay the full balance every month. The alternate type is the revolving credit. I can continuously withdraw, I can continuously repay. An example of that is my overdraft account with a bank. Or I could have a credit card. I pay my minimum dues and I roll over the balance. I keep on doing this continuously, and this is what my revolving credit would be. Apart from open-ended credit, I could get a closed-ended credit where I could have installment sales. Example of that is a car loan. I pay back in a given installment. I could have an installment cash credit, a personal loan. Now what's the difference? Car loan is a non-discretionary loan, meaning when I take a car loan, I must buy a car. I do not have a choice of buying something else. The end use of this loan, which is installment sales credit, is pre-decided, and I apply for the loan. But when I take a personal loan, I may buy anything. I may use that money for anything, which means the end use of my personal loan, which is the installment cash credit, is not pre-decided. And the third type is single lump sum credit. An example of that is interest only loan. Now what is an interest only loan in United States? Let's take an example. I take a home loan, a mortgage loan of 15 years. During the period of 15 years, I do not pay anything towards the principal amount. I pay only the interest on that. And at the end of 15 years, I pay the full amount of principal as one single bullet payment. So this is what I'm calling as a single lump sum credit. To repeat, the reason I'm explaining this is the regulation and the process will change depending upon whether it's an open-ended loan or a closed-ended loan. Let's now move forward and dive a little deeper into the applicability of the regulation. And now I'm starting with the loan sourcing process. In our loan sourcing process, we spoke about two steps: advertisements and application. Now before we move there, let me also introduce you to the Code of Federal Regulation. I got another slide showing you the electronic Code of Federal Regulation. Now when it comes to lending in United States, we need to always understand Title 12 of the Code of Federal Regulation. The Title 12, as you can see on the screen, is for banks and banking. And under this Title 12, I'll be having various regulations, which you can now see the regulator types, different kinds of regulators. Our focus is going to be mainly on the Federal Reserve System. And then at the bottom, I'll also be speaking about the Consumer Financial Protection Bureau. I'll be using two major entities here to explain the regulation in United States. So when coming back to the regulation will apply to different stages of the loan. And I am currently speaking about the first stage, which is the loan sourcing. So when the loan sourcing is to be done, there are typically different regulations applicable. So when I advertise, there will be a regulation applicable to that. When I get the application, there will be a regulation applicable to that. Before I start with the regulation, let's understand another component. Another component is sometimes, especially in respect of the mortgage lending in United States, you need to use an identical loan application form across the institutions. You are seeing on the screen now a uniform residential loan application form. This is called as form number 1003, which is a standard form used across the industry for giving residential loans or mortgage loans. Now what is the purpose of having such a form is what I will explain before we move forward to understanding the regulation. As we said earlier, in United States for consumer loans, we'll have two kinds of markets. A primary market where the lender will lend the money, and in the secondary market, the lender will sell that loan. in the secondary market. So when the lender wants to sell that loan in the secondary market, the buyer in the secondary market may need certain standardized data about the borrower. So how will we get this data? We need to get this data at the inception itself when the borrower applies for the loan. So if the borrower is told to provide, he is asked to provide a standard data across the industry, then across the industry my process of acquiring the applicant's data becomes standardized, and two, my assessment of that application also can become standardized. And with this standardization of the application form and with the standardization of lending and the assessment norms, my loans can now be transferred or sold from one entity to other entity in a easier or a simpler way. That is the objective with which you have this standardized loan application forms, and this would mainly apply to the home loan industry, that is the mortgage industry in the United States. Now let us begin the discussion on the applicable regulation to the loan sourcing process. The biggest act which has to be considered is the Patriot Act. So Patriot Act is actually an abbreviation. It's a 10-letter abbreviation, USA Patriot Act. When we expand it, the full title is Uniting and Strengthening America, which stands for the USA, by providing appropriate tools required to intercept and obstruct terrorism. So providing P from that, appropriate A, T, tools required to intercept and obstruct terrorism becomes the Patriot Act. So USA Patriot Act is the law which requires you to ensure that anybody who is applying to you for a loan, or in fact for any account, you need to have the appropriate information about the party. There is another law called Banking Secrecy Act, also requiring you to have consumer identification requirements. Now there is section 326 in the Patriot Act. The section 326 requires every financial institution to implement a process where we verify the identity of a person, of an applicant trying to open an account, including a loan account with the bank. So banks must implement the process of ensuring that they know the identity of the person. In some countries like India, we will call this as the KYC, that we must know your customer before you start lending the money to the customer. This is process one. Now this is not typically applicable only to lending. As we said, the laws could become applicable to many other processes or many other products, including deposit products. So Patriot Act is not only for lending, it is also applicable to the deposits. Now let's move to the regulation related to lending. The most important regulation currently impacting the consumer lending in USA is the Truth in Lending Act, also known as the Regulation Z. Now the Regulation Z will tell you that whenever you are advertising, whenever you are getting the application, and throughout the process of loan, you must go on making continuous disclosures to the applicant and the borrower about the products which you are offering to the consumer. Let's have a look at the Regulation Z. I'm going to take you through the Bureau of Consumer Financial Protection, and in this Bureau of Consumer Financial Protection, I will look at the Reg Z. These are all the different kinds of regulations available. So out of this regulation, let's choose Reg Z. Now this is Regulation Z, Truth in Lending Act, applicable to all your consumer lending. So in this act, we'll have the requirements. So we have, as we said, we have classified the loans into two types. We spoke about the open-ended credits. We spoke about the closed-ended credit. And I was just telling you about the loan sourcing process. And in the loan sourcing process, we'll have the advertising. So we'll have a regulation telling you that in open-ended credit, how do you advertise? Same thing will be available also in the closed-ended credit loan. So when you advertise, your advertisements must meet the requirements given in the Truth in Lending Act, which is implemented through Regulation Z. So this is point one which we need to understand. In addition to the advertisement, when we advertise and provide the information to the applicant, there will be general disclosure requirements about the open-ended loans, about the closed-ended loans. Then when you approve the loan and open an account for the customer, there will be account opening disclosures. At that point of time when your loan is disbursed, you need to disclose to the consumer the related terms and conditions in the proper way, and you need to comply with the account opening disclosure requirements of Reg Z. Then periodically, for example, in a credit card, you may be submitting a periodical statement. Every monthly you are submitting a statement to your credit card holder about the dues to be collected from them, then the finance charge, the interest which you have charged to them, that will be given in the periodic statement. So how will you provide the periodic statement to the parties, your customers, the borrowers? That is regulated again under Truth in Lending Act. Then when they make the payments to you, for example installments or a credit card customer paying you something back, then how those payments should be handled is again regulated in Truth in Lending Act. Then we have the treatment of credit balances. Sometimes the consumer may pay more than what's due to you. In that case, how it is to be handled? If there is a billing error, you billed incorrectly to the consumer has filed filed a complaint, how do you handle that? Comes under the billing error resolution. Then we have the determination of annual percentage rate and disclosure of APR. How do you disclose and decide the rate of interest applicable to the loan is also covered under the Truth in Lending Act. So the first law which we have discussed is the Truth in Lending Act. It's implemented through Reg Z. Now the objective of the Truth in Lending Act, to summarize, is to ensure that the customer is not cheated by the lenders. The customer has got full information before the customer decides to take an action, whether to accept the loan, and during the loan, what is the way in which the recovery or collection is going to be made, what is the way in which he is going to be charged interest. So this is the TILA or Truth in Lending Act. The second important law is the Equal Credit Opportunities Act. The purpose of the Equal Credit Opportunities Act is to promote the availability of credit to all creditworthy applicants, which means that whenever you sanction a loan, the loan should be sanctioned without considering the race of that applicant, the color, the religion, the national origin, the sex, the marital status or age of that applicant. The only thing which you should look at while you sanction the loan is the creditworthiness of the applicant. The law prohibits any lending practice that discriminates on the basis of something like the race, color or the religion. This is implemented through Regulation B. Let's have a look at the Reg B briefly, not diving deeper into Reg B. I'm opening the Reg B now. Here we see the Regulation B, Equal Credit Opportunities Act. And again here in Equal Credit Opportunities Act, you'll have the requirements given as to how would you ensure that only creditworthiness is looked at by the lender and no other factor is considered while deciding to give the loan. This is the second applicable regulation. Now this TILA and the Equal Credit Opportunities Act will in fact apply to all the three steps: sourcing, as well as origination, as well as servicing. So this is not what applies only to the first step. So this is applicable everywhere. The other act, which is an important one, is called the Unfair, Deceptive or Abusive Acts or Practices Act. So this is called UDAP in plain language. In spirit, the UDAP regulations are designed to protect vulnerable customers, because there are many parties who will not be able to understand the products which are offered by the banks. So the concept of UDAP is to protect such vulnerable customer. Now the customer could be vulnerable because of age, maybe he is a minor, or maybe is a person who does not have adequate understanding, maybe because of some physical disability, maybe because of race, because of low or limited literacy, the consumer has become a vulnerable consumer. Then the law protects such vulnerable consumer from unfair practices, from deceptive practices and from abusive practices. Now an unfair practice may be that you are charging more interest to a particular type of a customer because of his race or color or sex. This could be called as an unfair practice. A deceptive practice could be your advertisements are misleading. You are not giving them appropriate information. You are giving the information in very, very small print, fine print. Or sometimes in some countries you see these advertisements of mutual funds on the television. They speak so fast that you are not able to understand that. In USA, this would be called as a deceptive practice. That oral delivery that is very fast paced is called a deceptive practice. You could have an abusive practice, that you take unreasonable advantage of the consumer's lack of understanding of the products. So the law in lending prohibits you from deceiving the customer, from being unfair to the customer, and abusing the customer. So this is the law. Again, is going to apply to all these three steps, not applicable only to sourcing. Then we go to loan origination process. When we speak about loan origination process, all the banks across the world look at the ability of the borrower to make the payment. But the American law has put this specifically in the law itself, that the lender must verify the borrower's ability to make the payment. Again, I'm going to take you back to show you where this is including. I'm going to back again in the Truth in Lending Act. So when we look at the Truth in Lending Act, I'll be able to show you where those laws are included. Now we're back to Truth in Lending Act. In Truth in Lending Act, I'll have minimum standards for a dwelling. Let me go there. Here we have the minimum standards for transactions secured by dwelling, and this requires you to ensure that the borrower has the necessary capacity to make the repayment. So let's go down to that point. Here you can check that repayment ability, and there will be 8 parameters. I'm going to show those 8 parameters to you separately. That the law wants you to ensure that the repayment capacity of the applicant is checked properly. This was applicable to certain kinds of mortgage transactions. In addition to these mortgage transactions, you will also have some other standards, other transactions where this law has to be complied with. So let's have another look. We'll have this 1026.51 applicable to credit cards and open-ended credit offered to college students. Again, here we are required to check the ability to pay. So the law stipulates to you that you must check the ability to pay of the borrower. So this is the law which you need to comply with. Then, as I said, this is the part of the TILA, Truth in Lending Act. Then we have the Equal Credit Opportunities Act, which we already discussed. In addition to this, you will be taking credit report of various applicants from the credit scoring agencies, somebody like the Fair Isaac, somebody like the Experian or TransUnion. So these agencies will build the credit scores on the basis of reports received from various lenders and various other institutions. Those institutions which report the data about the applicant to the scoring agencies must do it in a fair and a proper manner. Regulation V covers the Fair Credit Reporting Act. So you will have a consumer making an application. That application has to be reported to somebody like Fair Isaac, the FICO. Then when you give the loan, you have to report that to somebody like the Fair Isaac. And when the collections and the recoveries are happening, again you need to do the reporting. When you do the reporting has to be done in the objective way. You should not be getting biased by the kind of customer which you have, who is applying to you, or maybe who is taking a loan from you. So the next law which is applicable, implemented to Reg V, is the Fair Credit Reporting Act. Then another different situation we have in the United States is the community property. Now this comes at this stage of application. Let me explain what this concept of community property means. There are two kinds of states in United States. Those who observe the community property law and those who don't observe. If you see the screen, there are some states which are in color blue, and those states follow the community property law. Under the community property law in United States, the property of a husband and wife couple is jointly owned. So joint ownership is automatically presumed in the law unless they are able to prove that the property is owned only by one of them. In fact, in some jurisdictions, some locations like California, it is assumed that the husband and wife own everything in the proportion of 50-50. That is 50% to the husband, 50% to the wife. Now, how does this affect the lending? Now, imagine that you are in a state which follows the community property law, and now you take some security from the husband. Let's say you take the house from the husband as the security, the home as the security. The home may be only registered only in the name of the husband, but because that state follows the community property law, the wife will automatically own 50% of that property. So in such states, while granting loans and taking security for such loans, we need to be careful of this fact whether the spouse would also become the owner of that property, and in that case collection and recovery could become a problem. So when we look at the regulation, we also need to ensure that the compliance of related community property regulation is done in that part of the state. Then there are certain laws, I'm not going to dive deeper into all these laws. There are certain laws which are applicable only to some types of lending activities. So we'll have a Real Estate Settlement Procedure Act, applicable only to loans against real estate, mortgage loans, implemented to Regulation X. Then you have the Home Ownership Equity Protection Act, HOEPA, again implemented through Reg Z. Now these are the laws which apply to the second step of origination. Then there is Regulation E, Electronic Fund Transfer Act. This will apply to your credit card transactions, again in loan origination step. Then sometimes the regulation has to be complied with jointly. Many laws come together. Here you say a combination of Truth in Lending Act and the Real Estate Settlement Procedure Act, jointly requiring a compliance. So to summarize, when you carry out the process of lending, you will need to comply with at the original step various laws which become applicable to your institution. Now I am coming to the last stage. The last stage is the Fair Debt Collection Practices Act. Last stage in the regulation part. The Fair Debt Collection Act. Again, now the customer is not making the payment. You need to follow up with him. Then when you want to follow up with him, the Fair Debt Collection Act will prescribe the procedure of how do we collect the money from the parties. So the Fair Debt Collection Act is the part of the US code, the US Consumer Credit Protection Code. Let's go to that 15 US code and look at chapter 41. This is title 15, Commerce and Trade, and in this title 15 I'll have chapter number 41, Consumer Credit Protection Law. And in this Consumer Credit Protection Law, in 41, gives you the steps which you need to follow for carrying out the transaction. So let me open that 41. Give me a second, please. So now you want to collect money, is coming under Fair Debt Collection Practices Act. So now how do you collect money? From whom do you collect money? Will be covered under the Fair Debt Collection Practices Act. Here you can see the Fair Debt Collection Practices Act. That you cannot harass the consumer, you cannot make false or misleading representation, you cannot follow misleading practices, unfair practices, you must contact the customer only in a given time. All such requirements will be coming when we have to collect the money from the borrower. So these are the three steps which we spoke about. Step number 1, loan sourcing. Step number 2 is the loan origination. Step number 3 is the loan servicing. Now last point, all these laws have been in place and they have been introduced mainly after the subprime crisis. That is, Dodd-Frank Act required these changes to be made. But after Mr. Trump, Donald Trump took over as the President of the United States, he has introduced recently a law called the Financial Choice Act. Now the Financial Choice Act, the choice stands for creating hope and opportunity for investors, consumers and entrepreneurs. This law has already been passed by the House of Representatives on in June 2017, June 8th in fact to be precise, 2017. Now this bill or this Choice Act proposes a number of significant changes to the US financial regulatory framework, including those laws which we have discussed just now. So though I have spoken to you about something like the Consumer Financial Protection Board having so much of power to regulate the lending or to ensure that the consumer's interest is protected, the Choice Act wants to do away with some of the provisions which we have discussed. So if Choice Act becomes the law, tomorrow the regulation which we have discussed may undergo a change. That's the kind of notice which I wanted to give to all of you before we conclude on the regulation part. Now let's go to the lending products. This is the last and the third part of my discussion. Now when we look at the lending products in USA, this is the consumer lending which you see on the screen. Let's go to the website of Fed to get the details. So when I talk about the Fed, we are talking about the economic data given by the Federal Reserve Banks. So let's look at the economic data. We are on consumer credit. So let's look at the total consumer credit in United States and then move forward with the products. So now what's the amount of total consumer credit in United States as of now? As of now meaning in January. So this is updated up to March 7th. The total consumer credit, that is retail loans given by all entities which we discussed and which fall under the category of banking industry, depository institutions, is 38.549904 billions of dollars. This is the amount of consumer credit which you have. And then if you visit this website, I'll not be diving deeper into this, you can get different kinds of loans. Then you can get student loans, you can get revolving loans, you can get credit card loans, all different categories, and how much is the exposure each of those parties are having. Why I'm discussing this to you is to show you the type of loans and the component each of them have in the total loans. Now I am coming back to this PPT. On the PowerPoint you will see that out of the total loans which you see on the screen, 68% loans are mortgage loans. That is what we call as home loans in some of the countries. 3% loans are home equity loans. That is using house property, somebody has taken a revolving loan. 9% of the loans are auto loans. 6% of the loans are credit card loans. 10% loans are student loans and 9% loans are remaining. So the biggest chunk is the mortgage loan, and therefore in US consumer industry, consumer market, mortgages are highly regulated both from the prudential regulation perspective and also from the consumer protection perspective. The second biggest chunk of 10% is student loan. The third biggest chunk, 9%, is our auto loan. So I'm focusing my discussion now on the mortgages. Then we'll briefly speak about student loans and the auto loans. Let me begin with the mortgage loans. Now when we come to mortgages, as we know now that all your laws like Truth in Lending Act, the law like the Equal Credit Opportunities Act, the UDAP, all will become applicable to mortgages. Now when it comes to mortgages in USA, the states in United States are divided into two types so far as the security of the property is considered. Now there are two theories. The first theory is the title theory. The second theory is the lien theory. In the lien theory, the borrower will buy the property in his own name and will offer it as the security to the lender. And in the title theory, the lender will have the property owned in the lender's name till the loan is outstanding. So in title theory, the lender is the owner of the property till the loan is paid back. And in the lien theory, the borrower is the owner of the property during the course of the loan. So we'll have these two kinds of processes depending upon the state in USA. Now having understood that, I already explained to you that I'll have a primary market and a secondary market. In the primary market, the lender will give a loan to the borrower, and once the lender has given the loan to the borrowers, the lender will sell those loans off in the secondary market. That is how the mortgage markets in United States would be working. And in the secondary market, we have got entities like the Fannie Mae or the Freddie Mac and the Ginnie Mae. Now, these Fannie Mae's, Freddie Macs and Ginnie Mae support or play a major role in the secondary market. Let's understand what their role is. Now, let's take an example. Let's assume that a bank called Citibank gives a loan to a person called Jack. Now, when they give this loan to a person called Jack, after giving this loan, Citibank is interested in selling this loan off to somebody else. They would now approach somebody like the Fannie Mae's or a Freddie Mac or the Ginnie Mae and sell the loan off to them or ask them to guarantee this loan so that Citibank can sell it off to another investor. So the role Fannie Mae, Freddie Mac and Ginnie Mae play is: one, they may purchase these loans from the lenders; two, they may guarantee such loans which are sold now by the lenders to another investors. That is the basic role which the government sponsored enterprises play. Now let's also recall the discussion we had about the standardized loan application form so far as mortgages are concerned. Now Fannie Mae's and Freddie Mac's will prescribe that form so that when a bank like Citibank lends money, by using that form, the data collected by the lender, in our example Citibank, will be identical across the United States. So when Citi is lending the money, or maybe Wells Fargo or some credit union is lending the money, they will use the same application form, which means the data which is gathered from the applicant is standardized. So in addition to having this standardized data, the Fannie Mae's, Freddie Mac's will also provide standardized norms for assessing and approval of the loan. This is where I'll introduce the concept of the conforming loans, super conforming loans, and non-conforming loans. Now Fannie Mae's and Freddie Mac's, the GSEs, may say that I am willing to support your loans provided you have given the loan by using my standardized form, and number two, you have followed a practice of sanctioning these loans in a standardized manner. And what is that standardized loan called? That standardized loan, which is given by following a standardized assessment practice, assessment method, is called the conforming loan. So conforming loan has a value norm. What is that value norm? Every conforming loan is a loan which is maximum amount, which every single loan has a maximum amount of $100. So we will have the value based limit, we'll have the assessment mechanism. There will be a front end ratio, there will be a back end ratio prescribed by the GSEs. There will also be the loan to value ratios prescribed by the GSEs. To summarize, if you sanction the loan within the prescribed amount limit, and by ensuring that you have the appropriate front and the back end ratios complied with, and also you have complied with the loan to value ratios, then the Fannie Mae's and the Freddie Mac's will support your loan or purchase your loan or guarantee your loan. In this way, the conforming loans are those loans which can be then sold off by the lender to somebody else easily in the secondary market. With this concept, we move on to the next point. Now the loans could be given to buy or build a property. There is this concept of manufactured homes also in United States. What's this manufactured home? A manufactured home is a prefabricated house. It is fabricated elsewhere and then assembled at the place where you want to construct the house. So the mortgage loans could be for building a house, and that building could be a prefabricated, a manufactured home. I may refinance a loan as well. Then I will also have products like the reverse mortgages and the home equity line of credit. Now both these products, reverse mortgages and home equity line of credit, are again loans given against existing property. And again there are regulations as to how do you sanction, approve the reverse mortgages. In reverse mortgages, they also need that the borrower must undergo counseling. In fact, there is a requirement that there is a HUD counseling session to be carried out, and only when the applicant has undergone the counseling process, then only he can apply for a loan. So there are extra steps involved in case of reverse mortgage loans as well as in home equity line of credit. This is the summary on mortgage loans. The other type of loan, an important one as we said, is the student loans. Like we had the Freddie Mac's and the Fannie Mae's in our mortgage market, we have the Sallie Mae in the student loan market, which is another bigger area in the United States. They provide loans for undergraduates, they provide loans for graduates, and they also have a consolidated loan program. What is a consolidated loan program? I may have taken an undergraduate loan from Bank A. When I moved onwards and took another loan for my graduation, so I have two loans, I can create one single loan by consolidating my student loan. So this is the second category, which is an important one in the United States. The third category is the auto loans. The auto loans again can be divided into different types. I have auto loans for new cars. I can have an auto equity loan against existing cars. We also give loans for recreational vehicles. You may have a motor home, a travel trailer, a pop-up camper, or a truck camper. For such campers, we will provide the loans. In addition to the auto loans and the recreational vehicle loans, we also give boat loans. You want to buy a sailboat, a motorboat, a yacht, or a boat trailer, you get the loan from the banks. Then you can have other vehicle financing, motorcycles, ATVs, all terrain vehicles, snowmobiles, personal watercrafts. For all such purposes, the parties will be giving the loans. So now to come to the conclusion, we have spoken briefly about the lending. Then we spoke about the objectives of lending. Then we spoke about the US lending market. We spoke about the entities in the US lending market. We spoke about the US lending regulation very briefly, because if you look at the regulation, in fact, the regulation runs into thousands of pages at one go. In fact, the Choice Act itself has got 600 pages. Then we spoke about the products, mortgages and the student loans and the auto loans. So at this stage, now I come to the conclusion of our discussion on the lending system. Now at this point, if you have any questions for me, we can go ahead with your questions. You can type your question on the question pane. I'll be able to see that on the question pane.